Ever wondered how successful businesses manage to financially recover the cost of that shiny new delivery truck? Or maybe an office building? Or even the cutting-edge software system they just invested in?
Yeah, it's not just a simple expense, is it? Taken all at once.
Exactly. It's more like a strategic, long-term dance with the tax rules.
Wow.
And it can really impact their bottom line.
Definitely.
So today, we're doing a deep dive into the fascinating world of cost recovery. It's a critical concept for anyone who owns a business or, frankly, anyone just curious about how companies manage their finances and, well, their taxes.
And our mission today is really to demystify all this stuff. Depreciation, amortization, depletion. We're going to pull out the most important nuggets of knowledge from the latest tax guidance.
Kind of a shortcut for everyone listening.
Exactly. A shortcut to being genuinely well-informed. We'll focus on the strategic impact, how these deductions can profoundly shape a business's financial health, its cash flow, and even investment decisions down the line.
Right. We're going to explore everything from the foundational system, MACRS, that's the Modified Accelerated Cost Recovery System, to some really powerful tax incentives, like immediate expensing.
Section 179 and bonus, yeah.
And even how less obvious assets, things like natural resources or intangible property, get their own special tax treatment. So get ready for some serious aha moments.
Yeah.
Because understanding these concepts, it can completely change how you view business investments. And financial planning, too.
It really can.
So let's unpack this then. At its core, what exactly is cost recovery? And I mean, why do tax authorities even allow businesses to do it in the first place?
Well, cost recovery is it's the tax system's way of acknowledging a basic truth about business assets.
Wow.
They don't last forever.
Things wear out.
Exactly. That truck wears down, the building ages, software becomes obsolete pretty quickly sometimes. So instead of forcing a business to deduct the entire cost of a major asset, like right up front.
Which could be a huge hit.
A huge hit, yeah. The tax system lets them recover a portion of those costs over time. It makes sense because it matches the expense of the asset with the income it helps generate over its useful life.
Ah, okay. So it smooths things out, gives a more accurate picture.
Precisely. Better financial picture, smoother cash flow. It's logical.
That makes perfect sense. So when we talk about property for cost recovery, we're talking about both realty, that's real property like land and buildings.
Right.
And personal property like equipment or vehicles. But, like you said, not all property is treated the same way. I can't just start depreciating my vintage guitar collection just because I decide to sell one online, can I?
Huh. Probably not, no. To qualify, assets must be used in a trade or business or for producing income. That's key.
Okay, business or income production.
And the second part is they must be subject to wear and tear, decay, or obsolescence. So yes, an office building used for business, absolutely. A dump truck definitely qualifies.
But not things that hold their value or don't have a set lifespan.
Exactly. Things that don't predictably decline or don't have a determinable useful life, like land itself that doesn't depreciate. Stocks, bonds, or your guitar collection generally wouldn't qualify unless you're like a registered dealer running a proper business.
Okay, so the asset has to be actively working for the business and losing value while doing it.
That's the core idea, yeah.
Now, here's something that I know catches people out. The placed in service requirement.
Yeah.
What's the actual difference between just buying an asset and placing it in service for tax purposes? It's not always the same date, is it?
No, it's not, and that's a critical distinction. For tax purposes, cost recovery, it doesn't start on the day you buy it.
Okay.
It starts on the date the asset is ready and available for its intended use, even if you haven't, technically switched it on yet.
So ready and available is the key phrase.
That's it. It's about when it's functionally prepared to contribute to your business.
Yeah.
So if you buy a big machine in December, but it takes until January to get it installed and operational.
January's your date.
January is your placed in service date. That's when the clock starts for depreciation.
And speaking of subtle but really significant things, what's this about allowed versus allowable cost recovery? That sounds like a potential trap.
It absolutely can be. It's a really important concept. Here's the core idea. The IRS basically assumes you should have taken any cost recovery deduction you are entitled to the allowable amount.
Whether you actually claimed it or not.
Exactly. So even if a taxpayer doesn't claim that deduction in a given year, maybe they forgot, maybe they thought they didn't need it, the property's tax basis is still reduced by the amount that could have been taken.
Wow. So your basis goes down regardless.
Right. Think of the tax basis as the asset's value in the IRS's eyes, your investment for tax purposes. That basis is reduced by the allowable depreciation even if you didn't claim it. This can really bite you later when you sell or dispose of the asset because your gain could be higher or your loss lower than you expect.
It's like a use it or lose it deduction. But even if you lose it, they still count it against your basis.
That's a perfect way to put it, yeah.
Okay, here's a practical one. What if you convert a personal asset, like say your family car, into a business asset? Maybe you start a side gig doing deliveries. How does cost recovery work then?
Good question. Happens all the time. When you convert a personal asset to business use, the starting point, the basis for calculating cost recovery, and also for calculating any future loss if you sell it, is the lower of two numbers.
Okay, lower of what?
The lower of the asset's original adjusted basis, basically what you paid for it plus improvements minus any prior non-business deductions, or its fair market value at the exact time you convert it to business use.
So you can't deduct the value drop that happened while it was personal.
Precisely. This rule prevents you from claiming a business loss for depreciation that essentially happened during its personal use life.
Makes sense. Prevents people from shifting personal losses into the business.
Exactly.
Okay, we've laid the groundwork. What qualifies, when it starts, basis rules. Now let's get into the engine driving most of this. The Modified Accelerated Cost Recovery System, or MACRS. What exactly makes it accelerated?
Right, MACRS. It's basically the IRS's standard operating procedure for depreciating most tangible business assets. What makes it accelerated is that it's specifically designed to let businesses recover an asset's cost over a time period that is generally shorter than its actual economic life, its real-world useful life.
Ah, so you get the deductions faster than the asset actually wears out.
In many cases, yes. The key insight here is that the tax code often encourages investment by giving you a bigger tax break sooner. It front-loads the deductions into the asset's early years.
Which helps with cash flow up front.
Big time. It provides a quicker tax shield, helps with immediate cash flow. And MACRS, well, it has slightly different playbooks depending on whether it's personal property or real property.
Okay, let's break that down. Let's start with personal property personality. And you mentioned certain types of realty fall on here too. How are those classified and what methods do they generally use?
Yeah, so for personality, think machinery, equipment, vehicles, office furniture, and some specific types of realty improvements. Properties are categorized into different recovery periods. You've got 3, 5, 7, 10, 15, or 20-year classes.
And how are those classes determined?
They're based on these IRS tables, the asset depreciation range, or ADR midpoint lives. It's basically a predefined, standardized, useful life the IRS assigns to, thousands of different types of assets. It just streamlines the whole process.
Okay, standard lives. And the methods, you said they're accelerated.
Right. Generally, the shorter classes, 3, 5, 7, and 10-year property use the double declining balance method. That's pretty aggressive.
Twice the straight line rate, basically.
Yep, applied to the declining balance each year. The 15 and 20-year classes typically use the 150% declining balance method, so still accelerated, just slightly less so.
And these methods stick around forever.
No, that's the clever part. Both of these accelerated methods automatically switch over to the straight line method in the year when straight line actually gives you a larger deduction. So it maximizes your deduction each year.
Got it. It optimizes itself. Now, what about timing within the year? You mentioned conventions.
Right, conventions. The default, the most common one for personal property, is the half-year convention.
Half-year.
Meaning you get treated as if you placed the asset in service right in the middle of the year, regardless of whether you bought it in January or December. So you get a half year's worth of depreciation in the first year and a half year in the final year of its recovery period.
Simple enough. But there's a catch, isn't there? Something about buying too much late in the year.
Yes. The mid-quarter convention. This is the planning gotcha you need to watch out for. It kicks in if more than 40%, that's the magic number, 40% of the total cost of your personal property placed in service during the year happens in the last 3 months, the final quarter.
And if that happens?
If that happens, you don't use the half-year convention. Instead, you have to treat all personal property placed in service during that year as being placed in service in the middle of the quarter it was actually placed in service.
So if you buy heavily in Q4,
You get much less depreciation in that first year. It can significantly reduce your first-year deduction compared to the half-year convention. It's basically a penalty for backloading your investments.
ouch. Okay, definitely something to plan around. You also mentioned certain realty uses these personality rules.
Yes, specifically, there is a category called Qualified Improvement Property, or QIP. This is an often overlooked but very beneficial category. It applies to certain interior improvements made to non-residential real property. So, commercial buildings after the building itself was originally placed in service.
Like renovating an office space, tenant improvements.
Exactly. Think tenant build-outs, remodeling interior spaces. But it specifically excludes things like elevators, escalators, or anything that enlarges the building's external framework or internal structural framework changes.
And the benefit for QIP.
The good news is these improvements get a favorable 15-year recovery period using the straight-line method and, importantly, the half-year convention. That's much faster recovery than typical real estate depreciation.
Much better than 39 years.
No, much better. And just as a quick side note, even for regular personal property, taxpayers can elect to use the straight-line method over the regular MCRS recovery period if they want. Maybe they prefer a slower, more predictable deduction profile.
Good to know you have the option. Okay, now for the really big ticket items. Real estate itself, the buildings, the structures. How does MFCRS handle realty?
For realty, the rules are actually a bit simpler, more straightforward. There are two main categories. First, residential rental real estate.
Apartment buildings, basically.
Yes, but with a specific test. 80% or more of the gross rental revenues must come from dwelling units. So apartment buildings count, but hotels, motels, places primarily for transient lodging, they don't. Residential rental gets depreciated using the straight-line method over 27.5 years.
37.5 years straight line. Got it. And the other category?
Non-residential real estate. This is everything else. Office buildings, factories, warehouses, retail stores. These use the straight-line method over 39 years.
Longer period, also straight line.
Yeah.
Okay. And the convention for real estate, is it half year too?
No, for all eligible real estate, both residential rental and non-residential, the mid-month convention applies.
Mid-month.
Mid-month. You get a half-month's depreciation for the month you place the property in service and a half-month for the month you dispose of it. Doesn't matter if it was the 1st or the 31st.
Okay, mid-month for realty, half year or mid-quarter for personality. Got it. Now, Congress often likes to goose the economy, right?
Yeah.
They use the tax code to encourage investment. And there are some really powerful tools for accelerating deductions, even beyond standard MCRS. Let's talk about immediate expensing Section 179 and bonus depreciation. These are huge.
They absolutely are. Game changers for many businesses. Let's start with the Section 179 election. This allows taxpayers to choose to deduct a significant portion, often the entire cost, of qualifying property immediately in the year they place it in service, instead of depreciating it over years.
Just write it off. Now,
Essentially, yes, up to a limit. For the current year, 2025, that ceiling amount is pretty high. It's around $1.25 million.
$1.25 million you can just expense right away. What kind of property qualifies?
It's pretty broad. Includes most tangible personal property machines, equipment, furniture. Also includes off-the-shelf computer software. Importantly, it also covers qualified improvement property, that QIP we just talked about.
Oh, so QIP can get Section 179 too.
Yes. And even certain specific improvements to non-residential real property, like roofs, HVAC systems, fire protection alarm systems, and security systems.
Wow, that's quite a list. So you can potentially write off a huge chunk right away.
Yeah.
But I imagine there have to be some limits, some guardrails, right? Otherwise, wouldn't every giant corporation just write off everything?
Exactly. There are 3 key limitations, and they apply in a specific order. They really tell you who this incentive is targeted at. First, there's that annual ceiling amount we just mentioned, the $1.25 million for 2025. You can't expense more than that under 179 in 1 year.
Okay, limit number 1.
Limit number 2 is the property placed in service maximum. The $1.25 million deduction starts to get reduced, dollar for dollar, if the total cost of Section 179 property you place in service during the year exceeds a certain threshold. For 2025, that threshold is around $3.13 million.
So if you buy too much qualifying property,
Your potential Section 179 deduction shrinks. If you place in service, say, $4.38 million or more of qualifying property in 2025, that's the $1.25 million plus the $3.13 million phase-out range, your Section 179 deduction is completely phased out. You get zero.
So it really targets smaller to medium-sized businesses who aren't making massive capital expenditures.
Precisely. That phase-out effectively restricts the full benefit. And the third limit is the business income limitation.
Can't create a loss.
Right. Your Section 179 deduction cannot exceed the taxpayer's aggregate business taxable income for the year, computed before the 179 deduction. And critically, it cannot create or increase a net operating loss, NOL. Any amount disallowed because of the income limit can be carried forward to future years, though.
Okay, so ceiling, phase out based on total investment, and business income limit. Got it.
And just a couple more points on 179. The expense you take reduces the asset's basis before you calculate any bonus depreciation or regular MCRS.
Order matters.
Order definitely matters. And a smart planning tip. Sometimes you can strategically designate Section 179 treatment for assets placed in service during that last quarter to potentially help you avoid triggering the mid-quarter convention for your other assets.
Clever. But be careful if you stop using it for business.
Yes, absolutely. There's recapture potential. If you expense property under 179 and then later convert it to personal use, or its business use drops below 50%, some or all of that prior deduction may need to be recaptured as ordinary income.
Okay. Now, the other big one, bonus depreciation. Additional first-year depreciation. How does that work? Is it even more aggressive?
It often is, yeah. Bonus depreciation is very significant. For 2025, taxpayers can deduct 40% of the cost of qualified property in the first year. Now, this percentage is actually phasing down. It was higher in previous years, so always check the current rate.
40% up front. What's qualified property for bonus?
It's also quite broad. It includes most depreciable, tangible personal property with a MACRS recovery period of 20 years or less. It also includes computer software, water utility property, and QIP. A huge advantage over Section 179 is that bonus depreciation applies to both new and used property acquired by the taxpayer.
Used property, too. That's big.
It is. Section 179 generally applies to new or used, but bonus definitely does. Now, bonus is taken after any Section 179 deduction is applied, but before you calculate the regular MACRS depreciation on the remaining basis.
So 179 first, then bonus, then regular MCRS on what's left.
That's the order. And here's the key power play for bonus. Unlike Section 179, bonus depreciation is not limited by the taxpayer's taxable income.
Wow. So you can create or increase a loss with bonus.
Yes, you can. This makes it incredibly potent for businesses making large capital investments, even if they have low income or are currently in a loss position. It provides a significant cash flow benefit regardless of current profitability.
That's a massive difference from Section 179. So with these two powerful tools, 179 and bonus, what's the thinking? How do businesses decide which to use or how to combine them for the best result?
Yeah, that's where the strategic tax planning really comes in. For many taxpayers, especially smaller businesses, they can deduct a very large portion, maybe even 100% of their personal property costs in the first year using a combination.
So what's the general strategy for, say, 2025?
Okay, as a general rule of thumb for 2025, businesses placing $1,250,000 or less of qualifying property will likely maximize their immediate deductions primarily using Section 179 since they're under the ceiling and phase-out threshold.
Makes sense. Use 179 first.
Right. Businesses placing $4,380,000 or more, remember, that's where Section 179 is completely phased out. They'll rely almost exclusively on that 40% bonus depreciation for their immediate write-off.
Okay. And businesses in the middle.
Yeah.
Between $1.25 and $4.38.
They'll use a combination. They'll likely take some Section 179, whatever's allowed after the phase-out starts, then apply the 40% bonus to the remaining cost of eligible property, and then use regular MACRS on anything left over.
So you layer them. But you mentioned sometimes deferring these is smart. Why would you not want the deduction now?
It seems counterintuitive, right? But yes, sometimes deferring is the smarter long-term play. For instance, if you're a startup with very little income in the early years, or maybe you have large net operating loss carryovers you're already using.
Taking a big deduction now might not save you much tax.
Exactly. Or maybe you strongly anticipate being in a much higher marginal tax bracket in future years. In those cases, a deduction later might be worth more than a deduction now.
So you might actually elect out a bonus.
Yes, you can elect out of bonus depreciation, either for specific asset classes or altogether. You could also choose not to make the Section 179 election, or even elect to use the slower straight-line method instead of accelerated MCRS, or simply delay placing assets in service until a more advantageous tax year.
Lots of planning levers there.
Definitely. And just one more quick tip. It's generally advisable to avoid using Section 179 specifically for automobiles because there are other separate limitations on cars that can make it less beneficial. We should probably touch on those next.
Good point. This brings up that whole area of assets used for both business and personal purposes. The company car that's also used on weekends, maybe the laptop used for work and home. Congress must have rules for this, right? To stop people writing off, I don't know, their vacation travel.
They absolutely do. Congress was very concerned about potential abuse here, so they established specific stricter rules for what's called listed property.
Listed property, what falls under that?
It includes passenger automobiles, other types of transportation like boats or planes, and property generally used for entertainment, recreation, or amusement. Now, here's a helpful update. Computers and peripheral equipment placed in service after 2017 are thankfully no longer considered listed property. That simplified things quite a bit.
Okay, so mostly vehicles and recreational stuff now. What's the main rule for this listed property?
The key is the 50% business use rule. For listed property to even qualify for the accelerated MCRS methods, or for Section 179, or for bonus depreciation, its qualified business use must exceed 50% in the year it's placed in service.
More than half for business, predominantly business use.
Exactly. It has to be predominantly used for business. And interestingly, using the asset for income-producing activities, like driving your car to check on rental properties, that counts for calculating the amount of your deduction, but it does not count towards meeting that crucial 50% business use threshold.
Ah, subtle distinction. Only trade or business use counts for the 50% test.
Right. And if your business use is 50% or less,
what happens then?
Then you're out of luck for the fast write-offs. The property must be depreciated using the straight-line method under the alternative depreciation system, or ADS, which generally means slower depreciation over a longer period. And once you're forced onto ADS for listed property because you failed the 50% test, you stay on ADS for that asset, even if your business use increases above 50% in a later year.
Ouch. So get it right the first year.
Definitely aim for that. Now, specifically for passenger automobiles defined as four-wheeled vehicles made primarily for roads, with an unloaded gross vehicle weight, GVW, of 6,000 pounds or less, there are additional dollar limits, the so-called luxury auto limits.
Even if business use is over 50%.
Yes. Even then, there's a cap on the total depreciation, including Section 179 and bonus you can take each year. For 2025, the first-year limit is around $12,200. However, if the vehicle is also eligible for bonus depreciation,
which it would be if business use is over 50% and it's new or used.
Right. Then that first-year limit gets a significant bump, an extra $8,000 for bonus, bringing the total potential first-year deduction up to $20,200 for 2025. These limits are then lower for subsequent years. And of course, all these dollar limits are reduced proportionally if your business use is less than 100%.
Okay, so cars under 6,000 pounds GVW have those caps. What about bigger vehicles like heavy SUVs or trucks?
Good question. Sport utility vehicles and trucks with an unloaded GVW of more than 6,000 pounds but not more than 14,000 pounds are not subject to those annual luxury auto depreciation limits.
The Hummer loophole people used to talk about.
Kind of, yeah. But while they escape the depreciation caps, their Section 179 deduction is specifically limited. For 2025, the maximum Section 179 you can claim on these heavier SUVs is capped at $31,300. Bonus depreciation can still apply beyond that, though.
Okay, different rules for heavier vehicles. Now, what happens if your business use starts above 50%? You take those nice accelerated deductions, but then in a later year, your business use drops to 50% or below. Does the IRS just let it slide?
Oh, definitely not. The IRS has a clause here. It's called recapture. If business use drops to 50% or less after the first year, you have to calculate the excess depreciation you took in prior years.
Excess meaning?
Meaning the difference between the accelerated depreciation, MCRS 179 bonus, you actually claimed, and the slower depreciation you would have claimed if you'd been using the straight-line ADS method from the start. That difference, that excess amount, gets recaptured.
Oh, added back to your income.
Yes. It gets added back as ordinary income in the year the business use drops. Ouch. And they also try to prevent people from getting around these limits by leasing instead of buying. There are rules that require lessees of luxury autos to include an inclusion amount in their gross income, essentially offsetting some of the lease deduction.
They think of everything.
They try to. And one absolutely crucial point for all listed property: substantiation requirements, record keeping.
Log.
Yes. You must have adequate records to prove the amount of use, the time and place of use, the business purpose, and the business relationship for expenditures. Contemporaneous logs, meaning kept as you go, are basically required for vehicles. No more guesstimates at tax time. You need proof.
Keep those mileage logs meticulous.
Yeah.
You mentioned the alternative depreciation system, ADS, a few times, mainly when business use is low or for certain elections. When must businesses use ADS? Is it always slower?
ADS generally uses the straight line method, often over longer recovery periods than standard make CRS. For example, personal property under ADS often uses its ADR class life, which might be longer than its make CRS recovery period. Real property under ADS is typically depreciated over 40 years versus 27.5 or 39 under make CRS. So yes, it's usually slower.
And when is it mandatory?
There are several situations. You must use ADS for calculating depreciation for the individual alternative minimum tax, AMT.
Ah, the parallel tax system.
Right. Also, it's required for tangible property use predominantly outside the United States. And importantly, for certain real estate, if a real property trade or business elects out of the business interest expense limitations under Section 163. This often applies to larger real estate businesses, those with average annual gross receipts over about $31 million for 2025. They trade faster depreciation for unlimited interest deductions.
Okay, a strategic trade-off there.
Yes. And finally, ADS is used to compute depreciation for calculating a corporation's earnings and profits, which affects dividend taxation. So it has several specific mandatory applications, even if most routine depreciation uses MACRS.
Okay, that covers tangible assets, things we can touch, see, kick the tires on.
Yeah.
But businesses have valuable assets that are invisible, right? Like patents, trademarks, brand reputation, customer lists. How do you recover the cost of intangible assets?
That's where amortization comes in. It's like depreciation, but for intangibles. The main rules are under Code Section 197. Most specified intangible assets acquired after August 10, 1993 are amortized ratably, meaning straight line over a 15-year period.
15 years, straight line, regardless of the intangible's actual life.
Yes, that's the key.
Yeah.
It applies starting in the month the intangible is acquired. Examples of these Section 197 intangibles include goodwill purchased as part of a business acquisition, going concern value, franchises, trademarks, trade names, copyrights, patents, and very commonly, covenants not to compete acquired in connection with buying a business.
So a flat 15 years for all those purchased intangibles. What about intangibles you create yourself, like developing your own software or building your own brand?
That's an important distinction. Generally, self-created intangibles are not Section 197 intangibles and aren't subject to this 15-year rule. Their cost recovery depends on other rules. Some costs might be expensed immediately as R&D, others capitalized and amortized over different periods, or maybe not amortized at all if they don't have a determinable useful life. But for acquired intangibles under Section 197, it's that standard 15 years.
Got it. What about the costs incurred right when you're starting a new business, before you even open the doors? Things like market research, legal fees for organizing, maybe training staff?
Good question. Those are startup expenditures. The tax code provides a specific rule here too under Section 195. If you're launching a new active trade or business, you can elect to deduct a small amount immediately.
How much?
You can deduct the smaller of the actual amount of your startup costs, or $5,000.
Okay, up to $5,000 right away.
But there's a catch. Similar to Section 179, this $5,000 immediate deduction is reduced, dollar for dollar, by the amount your total startup expenditures exceed $50,000.
Ah, another phase out. So if your startup costs are, say, $52,000.
Then your immediate deduction is reduced by $2,000, the excess over $50K, leaving you with only $3,000 you can deduct up front. If your total startup costs hit $55,000 or more, the $5,000 upfront deduction is completely phased out. You get zero immediately.
Okay, so what happens to the costs you can't deduct immediately? The rest of the startup costs?
Any amount not immediately deducted either because you exceeded the $5,000 limit or the phase-out reduced it is then amortized over 180 months, which is 15 years. Starting in the month the new business actually begins active operations.
Another 15-year amortization period. What qualifies as a startup cost?
It generally includes costs paid or incurred for investigating the creation or acquisition of an active trade or business, or for actually creating one. Things like surveys, market studies, travel, legal fees, accounting fees, consultant fees, provided they're costs that would be deductible if they were incurred by an existing business expanding its operations. Ordinary business expenses incurred after opening day are just deducted normally, not treated as startup costs.
Right. Makes sense. Okay, one more category. Natural resources. For companies that mine ore, drill for oil, harvest timber, how do they account for using up those finite resources? That's depletion, right?
Exactly. Depletion is essentially the depreciation or cost recovery method for natural resources. Think oil, gas, coal, minerals, gravel, timber. It represents the using up of the resource itself. Land, however, the surface land, cannot be depleted.
Okay. And how does it work? Are there some special rules for things like drilling costs?
Yes, particularly for oil and gas. There
Yes.
are costs called intangible drilling and development costs, or IDCs. These are costs for drilling and preparing wells that don't have salvage value in themselves: wages, fuel, repairs, supplies, etc. Taxpayers have a very important choice with IDCs.
Choice. What is it?
They can either elect to expense these costs immediately in the year they're incurred, deduct them right away.
Which sounds attractive.
It usually is, yeah.
Mhm.
Most taxpayers prefer to expense IDCs. The alternative is to capitalize them, add them to the property's basis, and recover them gradually through depletion allowances over time.
Why would expensing usually be better?
Primarily because of the way one of the depletion methods works, percentage depletion. As we'll see, percentage depletion isn't based on your cost basis. So if you capitalize your IDCs into your basis, but end up primarily using percentage depletion, you might effectively lose the tax benefit of those IDC costs altogether. Expensing them upfront guarantees the deduction.
Ah, okay. So that interacts with the depletion methods themselves. What are the methods?
There are two main methods for calculating depletion, and here's the key. You generally calculate your depletion allowance under both methods each year, and you deduct the larger of the two amounts.
Calculate both, take the bigger one. Got it. What are they?
First is cost depletion. This works very much like units of production depreciation for equipment. You take your adjusted basis in the mineral property, divide it by the total estimated recoverable units, like barrels of oil or tons of coal remaining at the start of the year, to get a per unit depletion cost. Then you multiply that per unit cost by the number of units sold during the year. That's your cost depletion deduction.
Based on basis and units sold. Makes sense. What's the other method? And this is the only method for timber, right?
Yes, cost depletion is the only method allowed for timber. The other method, available for most other minerals, oil and gas, is percentage depletion.
Percentage of what?
Percentage depletion is calculated by taking a specified percentage, which varies depending on the type of mineral, set by the tax code, like 15% for many oil and gas properties, different rates for coal, sulfur, uranium, etc., and applying that percentage to the gross income generated from the sale of the resource from that property during the year.
Gross income, not profit.
Gross income from the property, yes. However, there's a major limitation. The percentage depletion deduction cannot exceed 50% of the taxable income from that property calculated before taking the depletion deduction itself. For oil and gas, it's often 100% of taxable income.
Okay, percentage of gross income, but capped by taxable income from the property. What's so special about percentage depletion?
What's truly fascinating and powerful about percentage depletion is that it makes no reference whatsoever to the taxpayer's original cost basis in the property.
Wait, it's not limited by what you paid?
Nope. As long as the property is generating income, you can potentially keep taking percentage depletion year after year. This means it's entirely possible and, in fact, quite common, especially for long-lived, productive properties, for the total cumulative depletion deductions taken over the years to far exceed the original cost or basis the taxpayer had in the property.
Wow. You can deduct more than you ever invested. That's
Yep.
quite something.
It is. It's a significant incentive for natural resource extraction.
Okay, so we've covered MTCRS, Section 179, bonus, listed property, ADS, amortization for intangibles, startup costs, and depletion for natural resources. That's a ton of rules. How can businesses and their advisors strategically plan with all this? How do you optimize?
Yeah, it's a lot to juggle, but planning is key. First, just a basic housekeeping point. Always do an annual review of your fixed asset or cost recovery schedules. Look for assets that have been retired, disposed of, abandoned, or maybe become obsolete sooner than expected. You might be able to claim a loss or accelerate remaining deductions.
Good point. Clean up the records, then the bigger picture. Accelerate or defer.
Exactly. It comes down to that core question, accelerate versus defer. If your main goal is immediate cash flow, reducing this year's tax bill as much as possible, then you want to accelerate. Use Section 179 to its max. take bonus depreciation, use the fastest MACRS methods allowed.
Go for the biggest deduction now.
Right. But as we touched on earlier, that's not always the best long-term strategy. If you're maybe a new business with low income, or you have NOL carryovers soaking up income anyway, or you genuinely expect your marginal tax rates to be significantly higher in the near future.
Then maybe a bigger deduction later is worth more.
Exactly. In those cases, deferring deductions might be smarter. You could achieve this by electing out of bonus depreciation, choosing not to make the Section 179 election, perhaps electing the straight-line MCRS method instead of accelerated, or even, if feasible, timing your asset purchases to delay placing them in service until a more advantageous tax year.
It really depends on the business's specific situation and future outlook.
Absolutely. It requires forecasting and strategic thinking.
What about planning around amortization, especially when buying a business?
That's a really important area for planning. When you buy a business, the purchase price has to be allocated among all the assets acquired, tangible and intangible. Remember, goodwill and most other acquired intangibles, including covenants not to compete, are generally amortized over 15 years for the purchaser.
Right, Section 197.
So from the buyer's perspective, allocating more of the purchase price to assets with shorter recovery periods, like 5 or 7 year MVRS property, is usually ideal. But if the alternatives are assets with even longer recovery periods, like 39-year real estate, or assets that can't be depreciated or amortized at all, like land, then allocating value to 15-year amortizable intangibles, like goodwill or a covenant not to compete, can actually be quite advantageous for the buyer. It provides a faster write-off than land or buildings.
But the seller might feel differently.
Oh, very differently. This creates negotiation tension. For the seller, the gain on goodwill is typically treated as a long-term capital gain, which is usually taxed at lower rates. But payments received for a covenant not to compete are treated as ordinary income for the seller, taxed at higher rates.
So the buyer wants to allocate value to the covenant for faster amortization, while the seller wants to allocate it to goodwill for lower tax rates.
Exactly. It's a classic negotiation point in M&A deals, and how that allocation is documented in the purchase agreement is critical.
Fascinating how these rules create those dynamics.
Yeah.
And finally, just for practical purposes, where do people actually report all these deductions on their tax returns?
Generally, depreciation and amortization deductions for business assets are calculated and summarized on Form 4562, Depreciation and Amortization. The totals then flow from there to the appropriate business return, like Schedule C for a sole proprietor, Form 165 for a partnership, or Form 1120 for a corporation. Depletion is often reported on Schedule E or directly on the main business form.
Form 4562 is the main hub then. Okay. Wow, that was genuinely a deep dive. We've gone through some really complex, but man, incredibly important tax concepts.
We covered a lot of ground.
Yeah, from accelerating deductions with MACRS and bonus in 179 to the special rules for listed property, intangibles, and natural resources. It's clear that understanding cost recovery isn't just about filling out forms correctly. It's a powerful lever for optimizing a business's entire financial picture.
Absolutely. I agree. These aren't just, dusty, arcane tax rules buried in the code. They are active financial tools. And when you understand them, when you apply them strategically, they really empower businesses to manage cash flow, significantly reduce their tax burden, and make confident investments for future growth.
So thinking about everyone listening, what does this all really mean for you?
Well, maybe consider this provocative thought. We've talked about immediate expensing options like Section 179 and bonus, which pulled deductions into the present. We've also talked about scenarios where deferring deductions, pushing them into the future using ADS or electing out of bonus might be better. How might a really nuanced understanding of this interplay, the choice between immediate benefit and future benefit, influence your next major decision? Whether that's buying new equipment, acquiring another business, or even structuring the deal, it's about more than just this year's tax bill, isn't it? It's really about smart capital allocation over the long haul. How does manipulating the timing of these significant deductions shape your strategic growth, your risk management, and your financial resilience over the next 5-10 years?
That is definitely something to chew on. Thinking about deductions not just as a point-in-time benefit, but as a strategic timing lever.
Excellent. Well, thanks for joining us for this deep dive.
My pleasure.